Hey everyone, hope you're well, hope you're having a good one, and as always, welcome back to The Loft. Now today I wanted to just take a little bit of time to go over a metric that can be useful when trying to gauge a company and how well it is actually doing and how well it's able to use its resources in order to make an income and make a profit. So this metric is called return on equity, which is a little bit similar to return on assets that you may have heard of and that I will be doing a video about in the future, so make sure to subscribe for that. But back to return on equity. Return on equity is a measure of financial performance or profitability, and it's calculated by taking the company's net income and then dividing it by the shareholders' equity, and then we can use that to compare to either the industry average, another company, or a index such as the S&P 500. So if we jump straight into an example, and on this occasion we will be using Apple, and we look at their figures from 2020, we can see that Apple had a net income of 57.41 billion. And then we divide that by their shareholder equity, which in 2020 sat at 69.18 billion. And once this has gone through a calculator, we simply divide it and it spits out a total figure of 0.829, which we then convert into a percentage because that's how this formula represents its figures. And that brings us a total of 82.9%. Now we can use this to compare to other companies, the sector, or perhaps a ETF or something similar. And we can see that the overall average for consumer electronics in regards to the return on equity is around 30%. And because the higher the better, generally speaking, this means that we can see that Apple are able to generate a better return and a higher amount of income using the same amount of assets that are available. As I mentioned, you can compare this to the sector. So I'm just going to quickly display a full list of the average sector overviews now so that you can use that if you're looking at running any particular analysis, though obviously remember that this will change from time to time. There is also a rule of thumb that you can use, which is that the S&P sits at around 15%. So therefore anything of 15% or higher, you could review as good, whereas anything 10% or below is generally looked at as a poor outcome. Though it isn't always the case that the higher the better, this is generally the rule. However, there are some certain cases where an extremely high return on equity can actually be an indicator or a flag that there is a little bit of issue with a company. And this could be in the form of a company that suffered massive amount of loss, say over 7 years, consistent loss, which would have reduced the shareholder equity, and then suddenly have a windfall and therefore have a year with a load of profit. That would artificially inflate the return on equity because for the previous 7 years, the equity has been reduced through the constant loss. So therefore, when they post a decent return, it shoots it up as a relatively high return on equity. Therefore, it is something to look out for. It's a bit like a dividend trap in that case, but it is just a case of going in and looking at their previous history compared to their current history. The second option is the potential that a company could take out a lot of debt. So you need to look and see if the company has taken on a lot of debt to be able to cover, pay, anything like that. And the reason for this is that taking on debt will artificially raise the rate of return or the return on equity. And the reason for this is equity is calculated as the income minus the debts. So therefore, if we're increasing the debts, we are again reducing the equity portion of the calculation, which would artificially inflate the actual overall return on equity score. And the third option that you need to be aware of is that this won't work on a company that has either a negative equity or a negative net income, and you shouldn't use this for any company that has either or any of those factors. So just remember that when you're looking at it, and you should be able to avoid any particular return on equity traps. Now, that is all interesting, but what can we actually use return on equity for? And that is a very good question that I ask myself just to be able to save you asking that particular question itself. And the answer to that is that the return on equity can be used as a good starting place to work out estimates on stock growth as well as dividend growth and general growth rates of a company. So if you're interested in a video around how we can use return on equity in these equations to work out some form of growth pattern for a company, do let me know down in the comments below and I will look to do one of those videos sooner rather than later. The other benefit is that, as I have mentioned, you can use it to kind of gauge the profitability of a company and how its performance is going on, how it's making its earnings. And the reason for this is if there was a company that didn't take on any more assets or any more debt, and they generated more of a net income than they did the previous year, that would evidence the fact that they were able to use the same amount of assets available to generate a higher amount of net income, which therefore means that they're doing something right and they're being able to make more money out of the same amount of goods, which is what we want to be seeing from our companies. So that's a quick look into return on equity. And I do have a quick question to ask, which is this something that you've used before? Do you regularly use return on equity to gauge how well a company is doing and whether you should invest? Or is this something that you've seen on relative amounts of websites, things like Yahoo Finance, and you've just brushed it off and completely ignored it? Do let me know down in the comments below. It'd be great to find out. And also, if you're looking at a bit more resources to be able to review a company and decide if you would be investing in it or potentially trying to work out a price for that company, I would suggest checking out this playlist here, where I've got a few resources to help you do that. And until next time, remember to invest, save, and subscribe.